The Fiat Federal Reserve raised rates as expected in the middle of this week, albeit at a smaller clip, hiking them 25 basis points or 1/4%. Chairman Jerome Powell stated that he expects 2 more additional 25 basis point rate hikes to come, citing his typical data-dependent opt-out clause, of course. The spot gold price rallied on the news, and I took to a quick Twitter poll to get a check of my bullion-interested followers' sentiment, posing the following question. In a highly leveraged derivative gold price discovery market, staying grounded and aware of risks is often a difficult but required task to maintain one's well-being and emotional sanity. So surprised, not surprised. This morning, Friday, February 3rd, 2023, the same U.S. agency that consistently underreports ongoing price inflation data by half or more made a near all-time record-size seasonal adjustment to their non-farm payroll data report. This was all the excuse required to get algorithmic price sell-offs in spot gold and silver to ensue. So while it's a bit of short-term bad news for many of us, the seemingly eternal, patient bullion bull crowd out here, the good news is the physical bullion industry here in the USA has higher levels of inventory and slimmer price premiums closer to now consolidating spot prices. So for those of you out there who are still acquiring prudent bullion positions, now is probably a good time to add to one's position. Hello, on behalf of SDBullion.com, this is James Anderson with your weekly bullion market update. Before we go any further, smash the like button so we can share this content with other like-minded sound money stackers. Subscribe to our YouTube channel for more complimentary weekly updates to come, and don't forget to enter our free bullion giveaway.
Raise your hand if you like free stuff. We were going to give away a free tube of the brand new 2023 Silver Eagle coins. Then we said, nah, make it 25 tubes. SD Bullion is at it again with the Silver Eagle Monster Box sweepstakes. How many coins are in a Monster Box? Let's just say one lucky participant is going to be showing off their best celebratory dance moves with 500 shiny new Silver Bird friends. So head over to sdbullion.com/sweepstakes for your chance to win.
The silver and gold markets, as partially mentioned prior, rallied on the Fiat Federal Reserve's soft rate rise of 25 basis points middle this week, only to be sold off with the final spot price washouts coming from this Friday morning's phony BLS non-farm payroll data. The spot silver price closed the week just under $22.50 an ounce bid, while the spot gold price ends just under $18.70 an ounce bid. The spot gold-silver ratio briefly pierced below 80, only to climb to close the week, ending at 83. Probably the most important bit of silver and gold-related news this past week remains the World Gold Council's curious admittance and Financial Times coverage that government central bank gold buying is reaching annual levels not seen since 1967. That's roughly 55 years ago. It's not so much the incredible data that they're reporting that I'm so concerned with, more so for me a question of why now? After all, this has been going on and consistently underreported since the 2008 global financial crisis clued central bankers in that the current Fiat Federal Reserve note-dominated monetary system is highly unstable. What is the mainstream financial public being conditioned for? The amount of gold buying volumes by central banks at the moment have been consistently high and hard. So high, in fact, that we have to go back to prior to World War II and the Bretton Woods Agreement era to find volumes so thick and large as these. Even the IMF is now having to openly admit that central banks are increasingly, on net, buying gold bullion for their balance sheet reserves, instead of underperforming fiat currency denominated bonds or IOUs, or from holding major, increasingly devaluing fiat currency notes outright like the fiat US dollar, euro, yen, or pound, not sterling anymore. The last 22 years, based on what only is openly admitted, the East has been stacking official gold bullion and the West has been net selling of gold bullion as displayed here. Now, having posted this incredible chart, I was reminded that most precious metals interested onlookers and investors remain somewhat clueless on the timeline and history of gold. It's not their fault, I suppose. After all, this stuff is self-taught, and I work in this industry, so when asked what is the massive spike from 1967, what does it represent? Well, that is the last year before the London gold price rigging pool collapsed, so it represents a mad rush by trade surplus governments who were converting overprinted US dollars for gold bullion reserves. From 1968, and just a month and dozen years that followed, the gold spot price in fiat US dollar terms 24-folded, from a failed price rig of $35 an ounce to a high above $850 an ounce on January 21st, 1980. Even in a highly leveraged derivative market, such as the one that was happening in 1980, the spot price of gold can still run away from supposed financial authorities and nearly broke the system. In 1982, the CIA reported the following about the then 1980 gold market. Since the removal of $35 per ounce price ceiling in 1968, the desire to hold private gold as an investment hedge against inflation has grown dramatically. The introduction of gold futures markets into the United States in 1974 increased the volatility as well as the sophistication of gold trading. The ability to purchase and sell gold contracts at future dates on a highly leveraged basis has sharply increased the volume of trading. Over 34,000, quote, tons of gold, 25 times world production, was traded on U.S. exchanges during 1980. Exactly 10 years ago in 2013, the Central Bank of India admitted that the then physical gold versus outsized paper derivative gold market was trading at an over 92 times leverage back then. I can safely venture to say that the situation is even more highly leveraged and rigged today in 2023. And leverage can certainly be handy in price rigging markets for decades, until it isn't. The leverage, when it comes undone, typically does so in an opposite and violent reaction to the other direction. But don't take my word for it, and don't act shocked when it happens. I'm not going to cite numerous times in U.S. history where that statement has multi-folded the spot price of gold in short order. What I am going to leave you with, to close this week, is a reminder of what the Financial Times this week would not dare tell their readers of. If you've been following our channel, you might recall on last July 4th, 2022, a longtime City of London gold and precious metals derivative trader publicly admitted to the world that the day-to-day gold spot price we've been living under since the early 1980s is an utter sham. A canard, something to not be fooled by. I will leave a link to that important video regarding Peter Hambro's exact words on the matter of phony gold price discovery eventually ending in a new set of rules. The video is entitled Longtime London Gold Trader. Precious metals markets are paper derivative shams. I'll leave a link to that important admission in the comments and show notes below. Go check out that video if you didn't see it, and even if you did, I would suggest you go look at it one more time. That's going to be all for this week's ST Bullion Market Update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.